Good morning. Well, thank you for spending a few minutes with us discussing real estate investment. I've been a real estate investor for way longer than I've been in the mortgage business. I've been in the mortgage business since 2001, and I started investing in real estate in 10 years before that. So I thoroughly enjoy this topic. There, I can get my right screens up. So we're going to email you the PowerPoint presentation. So I'm going to not actually share it right now, but you'll have the details if you have any questions. So just to tell you a little bit about me, I have 9 rental properties of my own. I have 3 in a partnership. 2 of those are Airbnb properties. One's a beach property and one is a lake property. And then I have owned 2 office buildings, and one of them we've sold and done a 1031 exchange, and then we still own 1 office building. So some stuff in partnerships and some stuff that my husband and I have together. And I grew up with real estate in my blood. My grandfather was a builder and a real estate investor, and my dad and when I was young, my dad and his buddy would buy properties and renovate them and rent them. And so and my mother was a real estate agent. So I think I was doomed to become a real estate investor. It was in my blood, but I love it. And so I spent a lot of time trying to figure out how do you do real estate investing, leverage financing, and put yourself and your clients in the best position. So rental property financing is a little bit complicated. There's traditional ways to do rental property financing. There's kind of that medium way, we call it Alt A, and then there's hard money lending ways to do financing. So we're going to talk about a few of those options. So the real things about real estate investing is that there's cash flow versus cash. So you want to have as little money in the transaction as possible, because if you can keep your own cash, then you can go on to the next transaction. If you leave a lot of cash in the transaction, then that limits your ability to buy more property. But at the same time, the less you put into a transaction, the worse your cash flow will be. So those are the things we're always weighing against each other when we make real estate investing decisions. So just a recap on why real estate investing is so financially valuable. First of all, it's appreciation, and it's appreciation with leverage. If I invest $100,000 in the stock market and my value goes up to 105%, $105,000, I made 5%. If I buy a $100,000 house, I'm only going to put $20,000 or $25,000 down. So a $5,000 increase is a 25% gain. So the fact that you are able to use mortgage and financing as a way to build your real estate portfolio, that leverage significantly changes the wealth impact of real estate investing. Then, of course, somebody else is paying your mortgage. Rents come in, you pay your mortgage payment. As you pay those payments down every month, you're paying a little bit down to the value of the home. The mortgage balance goes down, and it's called amortization. The longer that you are paying your mortgage payments, the bigger that amortization is. So the houses that I've had for 20 years, every month I'm paying a massive amount of principal balance when I pay my payment, instead of the beginning when you're paying a very small amount of your payment is principal balance, and most of it is interest. So amortization can be very powerful whenever you're looking to refinance a rental property. That's something we want to talk about. Because you may be able to decrease your interest rate, but if you are all your payments, because you only have 6 years left in your mortgage, you're really only paying such a small portion of your payment is interest, that higher interest rate may not impact you. So every time we go through, you're going through a transaction, I'd love to be a part of helping you analyze the best thing to do and decision to make when you're trying to refinance or buy a new home, whatever. I gotcha. So there's also significant tax benefits to owning a investment property. You can, if you manage them yourselves, you can take write-offs related to your investment property. You could do things like a portion of your home. You could write off that kind of stuff. But then also there's depreciation. So every month, every year, you are depreciating generally 1/27th of the house value on your home. So if you buy a $200,000 house, you might say 20,000 of that is the land value. Well, your land you don't depreciate, but the rest of the house you depreciate, you divide by 27, and every year you get to write off 1/27th of the purchase price. And what that does is it sort of makes it so that you can pay your amortization and still be at a flat cash flow from a taxes perspective. So there's significant tax benefits. We can always talk to a CPA to help you understand that better. And it's a tangible asset. Like I am probably overinvested in real estate. That is something my financial planner tells me all the time. But I do like that I can see that house and I can touch it. And my money in the stock market is a little bit more difficult to, like I know it's very unlikely that the house is just going to disappear. And if it does, I have insurance. There's no insurance on my investments in the stock market. And then it's a great hedge against inflation. You know, generally when inflation is higher, then your rents are going to be higher and values are going to be higher. Housing prices are going to go up. And so, you know, the people who were very comfortable back when inflation was in the 20s were the people who owned real estate because housing prices were going up dramatically as well and rents were going up. So all of us need a hedge against inflation because, well, we've seen the impact over the last few years. So again, our goal is to have cash flow, which is what pays the bills and allows us to retire. But the opposite of that is how much cash do we put into a deal and how much cash do we leave in a deal after we adjust the long-term financing. So the first thing to talk about is conventional financing. Conventional financing is generally the best interest rates. It's what you're going to start with. You're going to start with conventional financing until you don't qualify anymore or the deal doesn't meet conventional financing, because then you're going to go to maybe a higher interest rate product to make the loan work. So a conventional loan requires 20 to 25% down. Multifamily properties require 25% down. Single family require 20% down. But there's a massive price improvement if you go to 25%. So a lot of my investors look at the cost of putting 20% down and 25, and a lot of investors will end up with 25% down because you might have to pay 2 additional points at 20% down. So we run all those numbers and look at the rates, and but lots of times 25% down is going to look a lot better in terms of your monthly payment and the cash to close anyway. So now, where do you get the money to do real estate investing? Now, it's great if we're all sitting around with a bunch of cash, but if you want to do real estate investing and you don't have a ton of cash, then we have to look at what are assets we can use as a down payment on an investment property. You cannot use a gift as a down payment on an investment property. So you can have cash or savings, or you could borrow from your 401k because that is your asset that you're borrowing against. That is a legitimate source of down payment. Or you could get an equity line of on your primary residence. And that is a completely legitimate way to get your down payment on an investment property. When you do have investment properties, like I have 10, you have to have a certain amount of reserves to show the investor that you can handle the cash flow. So most people will have that in like their 401ks or their IRAs. But anytime you're looking to, if you have 4 or 5 properties and you're adding the next one, I'm always calculating the reserve requirements to make sure that we are in good shape and something like that doesn't bite us down the road. A conventional loan is full documentation. So I'm going to need all the pages of your tax returns if you're self-employed or you have any rental properties, pay stubs, all the little details. Just like getting a traditional mortgage, we need all the stuff. There are other options, but this is the all the stuff option. And then the other thing to know is that in terms of your debt ratio, as long as you own a primary residence, you can buy an investment property and I can use the projected rent from that property to make your debt ratio work. So you may not have to have as much of a massive income to buy an investment property as you think. It's mostly important that you have the down payment and the reserves, because as you buy that next rental property, I can use the rental income that the appraiser says for that house, or if it's currently rented, I could use the current leases to offset the payment that you're going to have on the mortgage. A lot of loan officers don't know that. So if you hear people say that that's not possible, you're just talking to the wrong person. So cash out. So one option is to buy a house and or to get cash out on your primary residence or cash out on an investment property. Just so you know, those programs require that if you're paying off a mortgage, you have to have 12 months of seasoning. And you have to have owned the property at least 6 months. So a lot of people want to buy a house, renovate it, and then do a cash out. That does not allow you to use the after improved value of the house. So there is a financing option called delayed financing, which I'll talk about. But just a pure cash out loan, those are very difficult these days. And they restrict you to a lower loan to value. So cash out is probably not the way we're going to end up structuring how to get you out. So the first thing is, how do we get you into the deal? Are we going to renovate the property? And then how do we get you into long-term financing, unless you're going to flip? And most of my advice is going to be based on long-term financing, because that's what I know. So this is probably not the flip class. So now the strategy that I've used to basically buy all of my property is to buy the house with cash, and then ideally work with a partner to put a mortgage on the property. So I would get a private mortgage from a family member or a business partner that would have a mortgage on title that would be for the purchase price plus the amount of money that I need to renovate. That way, when I do my permanent financing, I am paying off a mortgage and I don't have all the restrictions that a cash out loan would have. I can go to a higher loan to value. The fact that I haven't owned the property for 6 months doesn't matter. I don't have the 12-month seasoning on a mortgage. So really, doing rate and term with a private mortgage of some kind is the way to do it. Now, lots of times, partners and I will be trading money to make that mortgage, that private mortgage work. So we can talk about how to architect that. But having a mortgage on title that we're paying off when we do the long-term financing is the way to get you the best interest rates and the highest loan to values. So we're going to talk about that when you're talking about buying investment property. We're going to have long conversations about how that works and what is the best way to do your takeout strategy. Because on a rate and term, you can go to 80% of the after improved value. So if I buy a house for $100,000 and I put $50,000 in that house, it might appraise for $200,000 if I did a really good job on buying a house that would have a lot of appreciation in it. Well, now I can get an appraisal for $250,000. I can borrow 80% of that $200,000. And now I have a $160,000 loan. So reality is I put $150,000 into the transaction, and now I've got a $160,000 loan on my $200,000 house. So the net of that is I'm walking away with very little of my own cash left in the transaction. And that is the key, is to leave as little in the transaction as possible. So we can talk through that strategy, but I have done it over and over and over and over. And the big key to that is building access to cash resources that you can use to buy the house and renovate it for a short period of time. So whether that's an equity line on your home, or you get investors that you work with that allow you to pool cash, being able to do a cash buy allows you to buy a house in bad shape, right? It doesn't have to be in good condition because I don't have to get a mortgage on it. It allows you to close super quickly. You can close on a cash deal in 7 days or something, and give you a chance to do your own personal inspections or whatever. So your cash up front to buy, which gives you a better position to buy the property, and then you're able to refinance at the after improved value of the house. So anyway, that's my triage position, and I'm happy to talk to anybody about how we make that work and down the road, because I know it's kind of tough listening to a webinar. All right, so delayed financing. We use this sometimes. What this does is it's an exception to a cash out, the cash out rule. So basically, if you buy the house with cash, say I buy the house with $100,000, I can do financing 2 months later, and finance and pay off my delayed financing loan. So I can never take more than the original $100,000, but I could do a loan to get back my $100,000. And basically that came about because everybody was trying to pay cash for houses, but they really did want loans. So you can go ahead and do that. Now we have to source all of that money that you use to put the down payment on. And none of that can be a gift. You can only get refunded delayed financing from sources that are considered legitimate sources for Fannie Mae. So a 401k, cash assets, obviously, and then maybe a equity line. But you can't use, if you use gift funds, they're not going to allow you to get that money back when you do the refinance. So I think the first step to real estate investing is buy your own house. If you don't have your own house, that's what I'm going to be telling you. You're going to have much better interest rates. You're going to have much better down payment requirements. You don't have to live there very long. Like you can move into that house, live there for 6 months, and then rent it and go buy your next house. But it's way easier to do primary residence financing than investment property financing. The second step is to get an equity line on your primary residence. If you have, as people have lived in your house 5 or 10 years, you probably have a significant equity position in your home. You should go ahead and get a equity line of credit, because even if you never use it, it is hugely valuable to be able to deal with short-term money movement. And so to me, it's a security blanket. Your risk only happens when you actually take it out. So there isn't any risk of just getting a second mortgage. All right. So now there's a bunch of people like me who have more than 10 properties, who have multiple businesses, who maybe have declining income or some craziness in their financial portfolio. There is a debt service loan that solves 90% of those problems. So we call it a DSCR. And basically what we're doing is we're using the rental income from the property to offset the payment. And that is all the income verification we do. You have to be a primary residence. You have to own a primary residence. But then what I can do is I can use the projected rental income from that property. As long as the projected rental income is more than the payment with an 80% factor, then I can make sure that the payments are, that's how we will qualify you. So you do have to have 20 to 30% down payment for a purchase, or we can do an 80% cash out. So these programs don't have all the rules that the conventional rules have with seasoning and everything. These basically are your credit score, your housing history, and the rental income from the subject property. These are super cool. You can close in an LLC. They don't have any limit on the number of properties you have. So you can have 10 or 12 or 20 properties. And all I'm going to say is tell me what the house is going to rent for and give me a credit report. And that's really what we're looking at. We also we do verify down payment and reserves. So like somebody like me who has all this property, I have to have reserve requirements. But it's super great for those folks who have a ton of real estate and have just given up, because after you have 10 properties and conventional financing, nobody wants to give you conventional financing anymore. Fannie Mae and Freddie Mac cut you off at 10 finance properties. So beyond that, you're going to go with a DSCR loan. Now, this is kind of the sexiest thing out there in real estate investing right now. The rates aren't that much worse than normal traditional interest rates for investment property. There is a prepayment penalty on most of them, a 2-year prepayment penalty. So it's not a short-term loan, but it solves lots of problems. It can close really quickly. We've had a lot of success with these programs. So I just want to make sure you guys know they're out there. It might be that you have some real estate investors who have given up, who really want to buy right now. And this might be the way to get some of those folks who've been on the sidelines back in the game. So short-term rentals, everybody does Airbnb now. I didn't do any Airbnb until 2 years ago. Now I have a mountain house and a beach house that's in the rental pool, and it is a fascinating experience. So we can do these DSCR loans on the projected rental income for a short-term rental. So if you have a house that's in the Airbnb program and you need to refinance, my program might be the only kind of program that works, because most conventional loans won't allow you to do refinance based on short-term income until you have 2 years of tax returns showing the income. So this is one of those tools we use. Basically what we do is we go, there's these databases that will tell you projected income for a property based on their address, the size, how much short-term income can you expect. We use 80% of that number, and that is how much we use to offset the rental income in the projections. And that is our income verification. So if you have short-term rentals, or you have people who want to buy short-term rentals, this might be a great program for them. So I wanted to mention 1031 exchange, because one thing that happens when you're an investor is that over time you are depreciating your asset, and that is great for taxes. But when you go to sell the property, you're not just paying taxes on the difference between the gain. Let's say you buy it at 150 and you sell it at 200,000. You're not just paying the difference on the taxes from 150 to 200, which would be $50,000. Over time, you've depreciated the value of that house over time. So your basis in that property might be $100,000. So you're actually going to pay capital gains on $100,000 of that money. And so selling is a challenge from the amount of taxes you're going to pay. So almost always I recommend try to do a 1031 exchange, because a 1031 exchange allows you to sell one and buy another. So for example, we sold our office building, and then we did a 1031 exchange. We bought a beach house, we bought a lake house, and then we also put money into a DST, an real estate investment trust at the same time, sort of spread out our assets. So 1031 exchange can be very powerful. If you have any questions about that, I'm happy to have that conversation with you. But when people want to sell and cash out of their rental properties, you really need to look at the tax consequences of that. It's almost always better to get into some sort of 1031 exchange. All right, there's also commercial options. I don't have these loans, but I do have clients who over time have done, and we did an investment property loan on our beach house, because that ended up being a better option than residential for that property, because condos and jumbo condos are so weird. So few things about commercial loans, just know that they have a 5-year balloon. So any loan that you get that's a commercial loan, you're going to have to refinance in 5 years. And that's just some exposure. We have some commercial loans and we have some residential. Also, those have to be amortized over 20 or 25 years. So your payments are generally higher on a commercial loan. But sometimes they're the right answer. I have had investors who do blanket commercial loans where they'll cover 5 or 6 properties with one blanket commercial loan. I don't know lenders that do that, but I have seen people have them. So commercial is just one of those things in the mix. When we're trying to figure out the right scenario for you, I may make that recommendation. So that's me wrapping up. I always promised we would stay under 30 minutes if at all possible. Just remember that we are licensed in a ton of states: Georgia, Tennessee, North Carolina, South Carolina, Alabama, Mississippi, yes, Alaska, Arizona, Arkansas, Alabama, Louisiana, Maryland, Michigan, Illinois, Florida, Virginia, DC, Colorado, Texas, Ohio, and West Virginia. So feel free to refer us to your real estate investors in other markets, or if you have friends moving to other markets, we would love to help them. Thank you for checking in.